All right. So I think we should begin. Um, and I want to just first of all say welcome to this webinar. My name is Lisa Smith. I use she, her pronouns. I'm the executive director of the Washington State Microenterprise Association. I'm a middle-aged white woman with blondish hair, blurred background. I've got a yellow turtleneck and a blue shawl. And I'm just really honored and appreciative of this program today. I'm also welcomed by Cherie Reeves-Spare, our incredible staff with WSMA, who also uses she or her pronouns. And we're here today to talk about loan forgiveness, student loan forgiveness. And we couldn't be more grateful to have Jessica Manfredi. We know that there are entrepreneurs all over Washington who are suffering with crushing student loan debt without any real avenues to recovery or relief. And why this is so important is you can't really get loans or you can't really move out of poverty when you have so many of these encumbrances. So part of why WSMA is so important is that we work to lower those barriers to self-employment. So before we begin, I just want to do a very brief slide deck for WSMA so folks who may not be familiar with our work to be able to just take a look at what we do. If you have any questions, we can go over those in the future, but we're all about helping the very smallest businesses. And we do this through nonprofits all over Washington and in order to lower the barriers to business ownership. And we do this with training, technical assistance, in grant making, and resource coordination. Again, this is about lowering the barriers. A barrier is student loan debt. And this is why one of the workshops we are doing today is so important. This is a webinar like the ones we've done in the past that serve people with disabilities or figuring out how to finance your business or sustainability or how to get health care for your businesses. So stay connected with WSMA if you want to learn more about ways your nonprofits can help businesses. We also are a grant maker. So we provide small grants to nonprofits around Washington, helping those very small, under 5 employee companies. And then finally, we work with Evergreen BizLink. We're the power behind this resource where any business anywhere in the state can get technical assistance, coaching, business tools, financing, tax credits, etc., on this really valuable resource. We have over 100 nonprofit partners that have applied and are on this platform to give small businesses resources. So that's what we do. You can reach us on social media, and thank you very much for just hearing that piece about WSMA. So without further ado, Jessica, I'd like to introduce you or have you introduce yourself and your background. You've done so much work to relieve the burden and barrier of student loan debt on these borrowers. And we will be posting links as you mentioned them. And so just feel free to just move through a presentation. And then afterward, we'll have an opportunity for questions in the chat. So welcome. Thank you for being here.
Thank you. Share. Oh, so there was a little bit of feedback there for a second. Hopefully everybody can hear me now. I'm going to go ahead and share the PowerPoint. And are you all able to see it? Just making sure.
Yep, it looks great.
Great, thank you. So hello, everybody. My name is Jessica Manfredi, as Lisa mentioned. My pronouns are she, her. I am the student loan advocate within the Washington State Office of the Student Loan Advocate. Today, we are going to be focusing on how to get your student loans forgiven or people that you serve through the income-driven repayment plans. And today's presentation is going to be about 40 minutes or so, and then we're going to have some time, like Lisa mentioned, at the end to answer any questions that may come up. And I think that they already mentioned that the slides will be available, the links will be available, so I'm just going to go ahead and get started. All right, so today we're going to give you a general overview of the Office of the Student Loan Advocate, which is the office that I work. at things like what we do and how we can assist borrowers. We will also move on then to explain how income-driven repayment plans work and how they may lead you to achieve forgiveness. I will also talk about briefly on some more common types of forgiveness options that may be available to you and the communities that you serve. We'll also touch on a little bit on return to repayment, since it's something that's going on right now, and some key dates that borrowers should be aware of. And then finally, at the end, I'm going to explain to you how you can get assistance from us if you have additional questions that maybe we don't answer today, or if you need to file a complaint against your student loan servicer. But we'll talk about that in a little bit more. All right, so just to give you a snapshot of what student loan debt looks like in the state of Washington, we have over 804,400 federal student loan borrowers as of June 30th, 2023. Our outstanding federal student loan debt balance is $29.1 billion. And our average federal student loan debt, so the debt that most people that have student loan debt to the federal government have, is $36,176 per borrower. So we put these numbers here not because we want to intimidate anyone, but because we really want to try to normalize, in a way, student debt as much as possible. Because whenever we talk about finances, right, personal finance specifically, there's a lot of shame and negative feelings and emotions that can be brought up by this topic. And we really want to drive the point home that student debt is common, that hundreds of thousands of people have it. So there's absolutely nothing for you to be ashamed about, and should be, in fact, talked about more often so that people can learn about resources like what we're talking about today and forgiveness options. So, and because student loan debt is a major issue for Washingtonians, in 2018, our state legislature passed what's called the Student Loan Bill of Rights. This law created the office that I work at, the Office of the Student Loan Advocate, within what's called the Washington Student Achievement Council, a state agency. But it also did a lot of really important things, like allowing our state to enforce state consumer protection laws against student loan servicers whenever they do anything that might be illegal to borrowers. Servicers must now also notify borrowers annually about our office and have information on how to contact us on their website. And it also allows borrowers like you or the people that you serve to submit complaints and questions to our office and get individual assistance and resources. And one of the materials we have created as a result of the Student Loan Bill of Rights is the Student Loan Education site, which covers things for people that are preparing to go to school, right? With modules like helping answer questions, how much should I borrow, all the way to understanding student loan terms, including resources for parents who may be thinking about borrowing funds for their children's education. So it is a great resource for anyone who thinks that they may need to take out student loans to pay for school, whether that's for themselves or for their children, all the way to those who are already out of school and they're looking for resources on how to navigate student loan debt. So I really would encourage you to share this resource with anybody who you may be serving in order to help them understand their student loan options and access different resources. And even though the Student Loan Education site is a great place to get started on learning about student loans, maybe you can run into a borrower that may have more questions that maybe that website or one of our other websites cannot address. So in that case, you can actually direct those with additional questions to about their student loans, or who are thinking about taking out loans, to ask us questions about things like the income-driven repayment plans and forgiveness, delinquency and default, how to get out of default, options for deferment and forbearance, other options for loan forgiveness and discharges, consolidation, in case that might be something that you're interested in doing, and any other general student loan question that somebody may have. At the end of this presentation, I'm going to explain to you in more detail how either you or someone that you're serving can reach out to our office to get help. All right, so we're going to switch to talk about specifically what's in the title of the presentation, right? The income-driven repayment plans that are also known as IDR for short. So because income-driven repayment is such a big word, I'm probably going to be saying IDR throughout most of the presentation, but I want to make sure that you understood what I'm talking about, right? So IDRs, or income-driven repayment plans, can be an affordable way for you to repay your student loans, and it can also potentially lead to forgiveness for some borrowers. It is important to know that the IDR plans and forgiveness that I'm going to be talking about today are specific for federal student loans, right? Not private student loans. Private student loans typically don't have any type of income-driven repayment options, and they tend to have very limited options for forgiveness or cancellation. So I just want to make sure that folks understand that this type of forgiveness and repayment plan that we're talking about today specifically applies to federal student loans, not private student loans. So just to give you an overview about the income-driven repayment plans, it is good to know that what IDR is, including that it can provide you a more affordable repayment option. For some people, it's as little as $0 a month. Borrowers have the ability to request that monthly payments to be recalculated right away if something happens that leads their household income to decrease, including things like separation, divorce, or losing a job. It can also be a good alternative to delinquency, default, and long-term forbearances or deferments that don't typically lead to forgiveness. And it is also a path to forgiveness in anywhere from 10 to 25 years, depending on specific eligibility. Now, it is important to highlight what IDR is not, which may be obvious, but maybe not. So we just want to make sure that we highlight this, is that IDR is not a quick fix or a magic bullet to student loan forgiveness, right? As it can take typically a long time, like I said, anywhere from 10 to 25 years for you to get forgiveness. Unfortunately, in the world of student loans, there's very little in quick fixes, right? But as I mentioned before, it is definitely a better alternative for folks that are low income in the long term, who would otherwise either default on their loans or struggle with really high monthly payments. And it also provides, even though it's further in the future, a light at the end of the tunnel with eventual forgiveness. All right, so before we talk about IDR, I think it's important for everyone to understand what are the more traditional repayment plans, right? So the plans that really don't take your income into account, that don't depend on your income, right? One thing that is universal between all of these plans is that they don't lead you to forgiveness, right? So the plans that I'm showing on this slide right here, you will be responsible for paying the entire balance on the loan by the end of the established term. Now, the 10-year standard repayment plan has 5 to 10 years of fixed monthly payments. There is an asterisk next to the column for forgiveness, because if you were working towards what's called public service loan forgiveness, I'll talk about that in a little bit more, some months under this plan will count as qualifying payments, but it's generally, even if you're going towards public service loan forgiveness, this is not the best repayment plan for you to be in typically in the long term. The 10-year repayment plan is usually best for people who can, one, afford the monthly payment, right? And then two, who want to pay the least amount of interest on their loans overall. This plan also allows you to have a fixed monthly payment, right? So meaning the same monthly payment throughout the entire 10 years that you're paying down the loan. Now, the 10-year standard repayment plan is a plan that's only available for those with direct consolidated loans. This is a plan that is also fixed, right? So the monthly payments are always the same for the duration of the repayment. And it can take up to 30 years for you to repay your loan under this plan. This plan does not count as a qualifying plan for public service loan forgiveness. Important for people to know because that can get confusing. Now, the 30-year standard repayment plan is best for people who want to lower their payments, but maybe under an income-driven repayment plan, they might not be able to get an affordable payment through that, right? So in those circumstances, monthly payments under an IDR can be too high for some borrowers. So in that case, the 30-year standard repayment plan may be a good option, even though it does not lead you to forgiveness. Then there's the graduated repayment plans. So payments start out low and increase every 2 years for up to 10 years. And then this may be a good option if you expect your income to significantly and progressively increase every 2 years. And this plan also helps you save some money on interest if you pay over time compared to like the extended repayment plans that we're going to be talking about next. And then finally, we have the extended repayment plans, which can be either fixed, meaning your payment is the same every month, or graduated, meaning that it increases every 2 years a little bit for up to 25 years. This plan is only for borrowers with debt that totals more than $30,000 in debt. And both the extended repayment plans are good options, again, for people that want a lower payment, but maybe are not able to get an affordable payment through one of the income-driven repayment plans, right? And who also maybe don't want to consolidate their loans to get access to the 30-year repayment plan. The extended fixed repayment plan may be a good option if you want fixed monthly payments, so you don't want your payments to change, while the graduated extended repayment plan may be a good option if you expect your income to kind of progressively increase every 2 years throughout the loan term. All right, now moving on to talk about those repayment plans that are dependent on your household income. The repayment plans that are known, once again, as income-driven repayment plans or IDR plans. These repayment plans are, in theory, designed to be affordable based on your income and family size. Monthly payment amount is generally a percentage of what's considered your discretionary income. And your discretionary income is based on 150 or 225%, depending on what plan you choose, of the federal poverty guideline for your state. And I do have a link here that takes you to those percentages in case you're interested in looking that for your family size. Now, discretionary income generally equals the difference between whatever your annual income is and 150 or 225%, again, depending on your IDR plan, of the federal poverty guideline for your family size and state of residence. And because the IDR payments are based on your income, it's important to know that your payment may increase or decrease over time, depending on your income, right? So it will likely not stay the same throughout the entire time that you're repaying your loans. And you do need to recertify your income for these plans every year in order to remain eligible, though that has become easier in recent years, and I'll talk about that a little bit more in a later slide. But it is important to know, like I mentioned earlier, that payments can be as little as $0 depending on your income, which can be a huge relief for borrowers that may be struggling financially. And it's also important to know that these plans can lead to forgiveness anywhere from 10 to 25 years, depending on the specific plan and more specific circumstances to each borrower. And we're going to talk about that in a little bit. All right, so keep in mind that an IDR plan may be a good option for you or people that you might be serving if you want an affordable monthly payment. You don't mind paying sometimes for a longer period of time in exchange for both a lower monthly payment and or potential forgiveness. Maybe you plan on qualifying for what we call the Public Service Loan Forgiveness Program after 120 qualifying payments, which is about 10 years. Or you plan on qualifying for income-driven repayment forgiveness after 10 to 25 years, depending on your income-driven repayment plan and loan balance. Or maybe you are temporarily unemployed or underemployed, but you don't want a deferment of forbearance, right? You want to continue making some progress in paying your loans or making progress on getting eventual forgiveness through this program. All right. So if you are pursuing an income-driven repayment plan for the purposes of eventually getting forgiveness, there's a couple of things that you need to keep in mind, okay? So you do not need to apply for forgiveness under this program. Once you hit the required number of years in repayment, Title VII Aid should automatically notify you of your eligibility, and it will actually give you an option to opt out of forgiveness. And now you might be asking yourself, Jessica, why would anyone opt out of having their student loans forgiven? Well, it's a little complicated, but under IDR, typically the amount that you get forgiven at the end is considered federally taxable income, which, depending on the amount that gets forgiven, can lead to a very large tax bill. However, due to the CARES Act, forgiveness under income-driven repayment will not be federally taxable until January 1st, 2026. So anyone reaching forgiveness in the next couple of years will not have to pay taxes on it. And it's also important to know that Washington State does not currently have income tax. But if you move to another state later on that does, that state may also charge you income tax for that forgiveness. So it's important for you to be aware of this. All right, so here's an overview of the current repayment plans that are available that are considered income-driven repayment plans. I say current because things are about to change a little bit next year, and I'll explain a little bit more about that. But the current income-driven repayment plans available are the Income-Based Repayment Plan, or IBR, Pay-As-You-Earn, or Payee, Saving on a Valuable Education, SAVE, which is very famous right now. A lot of you might have heard about it, and the Income Contingent Repayment Plan, ICR. All of these plans go by what's called the 150% of the federal poverty guideline when determining discretionary income, except for the Saving on Available Education, SAVE plan, which uses 225% of the poverty guideline to determine your discretionary income, meaning it protects more of your income, the SAVE plan. Now, moving on to talk about in a little bit more detail about each of these plans. For a lot of people, what I'm going to say is going to sound a lot like word salad because there's a lot of detail that goes into this. So it's okay if you feel like that, okay? But just know that after I go through these details, I will give you more information on how you can use a tool to help you determine which of these plans you may be eligible for and which one may be a good option for you, okay? So it's not like I'm just gonna go over this and then you're gonna be left hanging to dry to try to figure out what might be a good option for you. All right, so the IBR, or income-based repayment, caps your monthly payment at 10 to 15% of discretionary income, depending on when you borrow, okay? So whether it's gonna be 10 or 15% depends on when you borrow. Now, generally, 10% of the discretionary income is what's going to be used if you are a new borrower on or after July 1st, 2014, but never more than the 10-year standard repayment plan amount. Under the IBR as a new borrower, you will be eligible for forgiveness after 20 years of repayment. And then generally 15% of your discretionary income if you borrowed only after July 1st, 2014, but never more than the 10-year standard repayment plan. An older borrower under the IBR plan will be eligible for forgiveness after 25 years of repayment. Now, there's also the Payee, or Pay-As-You-Earn plan that caps your monthly payment at 10% of the borrower's discretionary income, but never more than the 10-year standard repayment plan amount. Eligibility depends on when you borrowed, right? That means that you would have to have taking on loans on or after October 1st of 2007, and with a disbursement of a direct loan on or after October 1st, 2011 or later. Under Payee, you will be eligible for forgiveness after 20 years of repayment. Now, there's also ICR, or the Income Contingent Repayment Plan, which is the only IDR plan that's currently available for Parent Plus borrowers. But it's important to note that Parent Plus borrowers do need to consolidate their loans into a direct consolidation loan in order to be eligible for the ICR plan. Also, the monthly payments under this plan are typically higher than the other plans because it requires 20% of your discretionary income. An ICR will lead you to forgiveness after 25 years of repayment. Now, as you can see from the asterisks that I have on this chart, there are some changes that are coming our way. Payee is no longer going to be available for new enrollment after July 1st, 2024, okay? But for those who sign up for the plan before then, or that are currently on that plan and want to stay on it, you will be able to stay on it. And the Income Contingent Repayment Plan, or ICR, starting July 1st, 2024, will only be available for consolidated direct loans that contain Parent Plus loans. However, we do have a brand new kid on the block, as I mentioned earlier, that's very famous, that you may have noticed that I skipped, which is the Saving on Available Education Plan, the SAVE plan, which actually replaced what used to be the Repay plan, okay? I'm going to dive a little bit more into this specific plan because it's very different from the other repayment plans, and it offers many benefits that the other plans don't. All right, so SAVE, or Saving on Valuable Education, is the newest, most generous repayment plan that federal student aid has put out. Repay, or the revised pay-as-you-earn plan, transformed into the SAVE plan, okay? So this means that if you were enrolled in SAVE prior to September of this year, which is when SAVE was first enacted, you will automatically, or should have already been, switched into the SAVE plan, okay? Now, SAVE increases the discretionary income exemption from 150% to 225% of the poverty line compared to the other repayment plans. This means that more of your income is protected, allowing for overall lower payments for most borrowers. Unfortunately, this plan is not available for Parent Plus borrowers. Now, the repayment terms for SAVE require 5% of your discretionary income for only undergraduate loans, 10% of the discretionary income for those with graduate loans, and then a weighted average for borrowers who have both undergrad and grad loans. The forgiveness timeline is a little bit more complicated when compared to the other plans, but for borrowers that had a low original total principal balance of less than $12,000 will be able to get their debts forgiven in as little as 10 years. Higher undergrad loans will be forgiven in 20 years, and any graduate loans, regardless of how much it was, the principal balance will take 25 years. While these are amazing changes, right, that are going to benefit a lot of people, unfortunately, not all these changes are going to be implemented at the same time. So the SAVE benefits that are going into effect right now and have been into effect since September is that there is an increase in the amount of income protected from payments, like I said, from 150% to 225% of the federal poverty guidelines. This change means that a single borrower, right, so who's earning less than $32,805 a year, for example, will have a $0 monthly payment. The department will stop charging any monthly interest not covered by the borrower's payment on the SAVE plan. So as a result, if you make your monthly payment under this plan, even if it's a $0 plan, monthly payment, as it is for some people, your loan balance won't grow over time due to unpaid interest. This means that under this plan, people will not have the issue that borrowers have had in other IDR plans of seeing their loan balances ballooning over time. Married borrowers who file their taxes separately, right? So this is very important. People that are filing their taxes separately who are married will no longer be required to include their spouse's income in their repayment calculation for SAVE, like they have to do for Repay in the past. These borrowers will also have their spouse excluded from their family size when calculating IDR payments, simplifying the choice for different repayment plans for borrowers that are married. However, some SAFE benefits are only going to be going into effect in July of 2024, including payments on undergraduate loans that will be cut in half, right? If you only have undergraduate loans, it's going to go from 10% to 5% of the discretionary income. Borrowers who, once again, have both undergraduate and graduate loans will pay a weighted average between 5 to 10% of their income based on the original principal balance of their loans. Borrowers whose original balances were $12,000 or less will receive forgiveness after 120 payments, which is the equivalent of 10 years in repayment, with an additional 12 payments added for each additional $1,000 borrowed above that level, up to the maximum of 20 to 25 years. So this means that, for example, a borrower that had a principal balance of $14,000, for example, will receive forgiveness in 12 years instead of the usual 20 or 25 that it would take under this plan. The SAFE plan calculates your monthly payment based on your income and family size, just like all the other IDR plans, right? Here you can see an estimated monthly payment based on income. This is, of course, for illustrative purposes only, right? But it gives you an idea of the types of savings that you or somebody that you might be serving may be looking for on their monthly payments if they end up enrolling on this plan. And just to let you know, there is a link available on the Federal Senate website that has an accessible version of this table. All right, so while the SAFE plan will likely be the best repayment plan for most borrowers who want to enroll in some kind of income-driven repayment plan, the best income-driven repayment plan for any borrower really needs to be figured out with a lot of factors, including things like when you took out your loan, your current loan type, your income, whether you are working towards other types of forgiveness, like public service loan forgiveness, whether you have undergrad or graduate student debt, right, or both, and also what your payment goals is in overall, also your marital status, including your spouse's income, your spouse's student loan debt, and your filing tax status, right, whether you're filing taxes together or separately. But obviously, you don't have to sort through all of this mess without resources, right? And that's what we're going to talk about now. All right, so you can get help picking a repayment plan, whether that is a non-income dependent repayment plan or an income-driven repayment plan, using this tool called the Loan Simulator tool. The Loan Simulator will ask you to log in with your Federal Senate ID, username and password, and it will pull your actual student loan data, things like your balances, interest rates, etc. And then it's going to ask you questions about your household income, your household size, tax filing status, etc. Based on that information, it will then calculate for you an estimated monthly payment under different repayment plans. So it's a really useful tool to help you choose the best repayment option for you. For IDR, it's really important to make sure that you enter the most updated income information, just so to make sure that you're getting accurate results. Please note that our office, unfortunately, cannot provide student loan payment estimations for borrowers, whether that's under IDR or other plans. So we just don't have the capacity to do that. So if you're working with someone or you yourself wants to estimate your monthly payment under different repayment plans, please use the loan estimator tool available on the Federal Senate website. All right, so if you decide to apply for an IDR plan, if you're like, you go to the loan estimator and you're like, Jessica, I know that IDR is the best option for me, right? The best way to apply, especially right now, when it can be extremely hard for you to get a hold of your student loan servicer because everybody's calling, is to apply online by going to the studentaid.gov website. Supposedly, the new application is only taking about 10 minutes. Borrowers have told me that it's really fast, so that's very exciting. Borrowers can get their monthly payment calculated in real time, and they can choose to have their IDR application recertified automatically each year. right? So this is really awesome because in the past, you would have to be resubmitting your income information every year to your servicer. But unless your income decreases from year to year, you can choose to just automatically have your IRS information shared with the Department of Education so that recertification happens automatically every year, and you don't have to be resubmitting paperwork every year. Borrowers that are applying for IDR plans on the FSA website will see the new payment amount that they're going to have before submitting the application. And it will also be displayed on their servicer's website when they receive their bill. Most borrowers who apply for an IDR plan can expect their next payment to reflect their IDR payment plan amount. But it's important to note that servicers will place borrowers in a forbearance if they need more time to process your application. So if they're slammed with a lot of applications, you might be temporarily placed into an administrative forbearance until they're able to process your application. So just be aware of that. After borrowers apply, they can check the status of their application by visiting their account dashboard on studentaid.gov. So it's really great that you have another way to track what's going on with your income-driven repayment plan application. Another thing that I want to make sure that I touch on, there's actually a special opportunity for borrowers to get closer to forgiveness under income-driven repayment through what's called the income-driven account adjustment, which is also known, another way that people have been calling it is called the payment adjustment. Now, the Department of Education created the IDR account adjustment to try and correct for those borrowers who in the past were unnecessarily steered into forbearances and deferments when they could actually have qualified for one of these income-driven repayment plans that we've been talking about and making progress towards eventually getting forgiveness. Now, the payment adjustment is a limited time opportunity, okay? So highlighting this part, it's limited time. Available right now for borrowers to potentially get closer to forgiveness. And it will be applied to all Department of Education held loans between now and 2024. Right? This adjustment will allow for certain periods of forbearance and or deferment to convert into IDR payments for borrowers in specific circumstances, including 12 or more consecutive months of forbearance, 36 or more total months of forbearance, months spent in economic hardship or military deferments after 2013, and periods of deferment before 2013, excluding in school. Any time spent in repayment, right, will also convert into IDR payments, including any payments made before a consolidation, in case you did consolidate your loans at any point in time. But it does exclude periods of bankruptcy or default. Any borrower with loans that have accumulated eligible time in repayment of 20 to 25 years will see automatic forgiveness, even if they're not currently on an IDR plan. Any additional IDR payments a borrower may get will also count towards public service loan forgiveness if they were employed in a qualifying public sector employer during that period of time. And the loans that hit the forgiveness thresholds, whether that is 240 to 300 qualifying payments for IDR or 120 qualifying payments for public service loan forgiveness, will start to get forgiveness as early as this year. In fact, the first group of folks that are eligible for forgiveness have already been notified, as you may have already seen in the news. However, it is important to know that final IDR and PSLF credits may not be applied for some people until sometime in 2024. I also really want to highlight that some people, depending on their circumstances, may actually need to act before the end of this year, 2023, to be able to take advantage of this opportunity. For example, if you will need to consolidate loans that are commercially held loans, such as Perkins and Fell loans. If you want to learn more about this opportunity, I don't have enough time to really go into in depth about it today. I would highly recommend that you watch my recorded webinar on the topic that is available on our website. And I highly recommend that everybody look into this specific limited time opportunity because it could really make a difference when it comes to achieving forgiveness, especially if you have been in repayment for those longer period of times that we've been talking about. But speaking of loan consolidation, If you apply to consolidate your loans between now and the end of this year, so December 31st, 2023, you will actually not lose your PSLF or IDR credit due to the IDR account adjustment. This is important to know because in the past, if you consolidated your loans, you could actually lose all your progress towards forgiveness. Right now, if you consolidate your loans, any type of loans, including Perkins, FEL, or direct loans, into a new direct consolidation loan, you will be credited with at least the same number of qualifying payments as your oldest loan on the same of the same type, right? So for example, if you have an older subsidized loan from your undergraduate degree that has 200 qualifying payments, and a newer subsidized loan from your graduate degree with 100 qualifying payments, your new consolidated loan, again, if you consolidate by the end of this year, would have at least 200 qualifying payments. If you do consolidate your loans between now and the end of 2023, it is also important to know that your PSLF payments, if you're working towards that, or IDR payments could temporarily reset to zero, but it will then be updated once the account adjustment is applied to your account. In short, this means that if you're considering consolidating your loans, doing so before the end of this year will allow you to retain 100% of your IDR and PSLF credit, especially if you have loans with more payments versus loans with less payments, making it a great time to consolidate if you may need to. Not everybody has to, right? All right, I also want to show you some data regarding the IDR adjustment and the effects it's currently having on borrowers in our state. So far, 16,310 borrowers in Washington state have received IDR forgiveness due to the payment adjustment of as of July 2023, right? As of a couple months ago. And that translates into $770 million that have been discharged as a result. As I mentioned before, the payment adjustment has not been applied to everybody's accounts yet, but it will continue to be applied to all ed-held loans between now and 2024. So likely more folks will end up getting forgiveness within the next year or so, those folks that have been in repayment for a long period of time. Those borrowers who have been in repayment for 20 to 25 years, most of them with like no light at the end of the tunnel, right? But who were finally able to get some relief through this opportunity, are really thankful for it. We have personally helped a few of these borrowers who are actually like in disbelief when they received that email from the Department of Education saying that they got forgiveness through this program. These were actually folks that we were working on with other types of forgiveness. One of them was working towards public service loan forgiveness, and another one was working towards a total and permanent disability discharge. But they ended up getting this faster because they had been in repayment for such a long time. And they really were thankful that this huge burden had been lifted off their shoulders. So it is important to highlight that even though the SAFE plan was only released a couple months ago, 74,800 Washingtonians have already signed up for it, many who are looking to make their monthly payments more affordable. And while income-driven repayment is one of the many paths that someone can take towards forgiveness, I did want to briefly talk about some other types of forgiveness that you may be eligible for, just in case, it might apply to you today. All right, so it is worthwhile for you to explore other types of loan forgiveness, including public service loan forgiveness, in case you are currently working in the public sector. In public sector includes anything from state government, nonprofits, federal government, tribal government. So a lot of people fall under this umbrella who might not otherwise think that they do. There's also teacher loan forgiveness, which is designed to encourage people to enter and continue in the teaching profession. There's also total and permanent disability discharge. And for this one, the online application is relatively easy. You can be eligible if you receive SSDI benefits and your next scheduled disability review will be within 5 to 7 years. from the date of your most recent SSA disability determination. You can submit a certification from a doctor of medicine or osteopathy that you are totally or permanently disabled, or you're a veteran that has a service-connected disability or disabilities that is 100% disabling. There's also closed school discharge, which you may be eligible for if your school closes while you're enrolled or soon after you withdraw. There's also borrower defensive repayment, which is a discharge for students who feel like they were taken advantage of or misled by their school. And there's many other types of forgiveness that I don't have enough time to talk about today. So if you're interested in learning more about these types of loan forgiveness and discharge, and more that I didn't talk about today, I would encourage you to go to the studentaid.gov website. All right, finally, some of you may have people that you serve that have defaulted federal student loans. And for those people that are in that situation, there is a temporary opportunity that allows you to actually get out of default very easily. And it removes the default record from the borrower's credit report and actually also stops collection attempts. To enroll, it only takes about 10 minutes. You need to contact your loan holder and basically just ask them to enroll in Fresh Start. If you don't know your loan holder, you can call the number on the slide to find out who they are. And I'm also including here a link to the Fresh Start page, which has a little bit more information on the program, as well as some options to do this program, to do the process online in case maybe you don't want to talk to anybody, which I completely understand. All right. So finally, just to talk about a little bit about returning to repayment, which is something that's in all borrowers' minds right now. We want to make sure that people know that it's actually going to happen, right? A lot of people have questions because the payment pause was extended so many times, but this time it's really happening, okay? This means that interest actually began accruing since September 1st of 2023. And bills or statements are going to be arriving to borrowers between September to October 2023. Your first due date will be sometime in October, so just in a few days. And the notice that you get should be at least 21 days before your payment due date, so it's important to know that. And because so many people are entering repayment at the same time, you are likely to experience loan call holds and wait times for assistance from your student loan servicers, okay? So try to use studentaid.gov and other online resources as much as possible to self-serve before you call your servicer, because you probably are going to be on hold a long time at this point in time to get help from them. All right. But I do want to let people know there is something called an on-ramp period. This period will last 12 months between October 1st, 2023 to September 30th of 2024, during which interest will still accrue, but it will not capitalize. And during this period, some of the harsher consequences that are usually associated with student loans not being paid monthly are not going to be applied. So it will not be, if you don't make a payment or you miss a payment or you make a late payment, you will not be reported to credit bureaus. You're also not going to be considered in default, and you will also not be referred to collection agencies. Now, this does not mean that you should not make payments. If you are able to do so, you are highly encouraged to do so, especially if you can qualify for some of those lower payments through some of the programs that we talked about today. All right. And then I just have here a few key dates that you should be aware of that I already talked about, so I'm not going to go over them again. But these are just so you know, regarding when repayment is starting, when safe benefits are going to be available, etc. And then if you want to stay updated on all student loan related things, I would recommend going to our website, the wasaf.wa.gov/loan advocacy, for all the recorded webinars that we have available to you, as well as to sign up to receive emails from us whenever we have new information available to borrowers. All right. So finally, and I know that we have to, I'm going to give some time for questions. it would be great if you could complete a short survey to just let us know how we're doing. Your opinion really matters to us to understand the needs of Washington student borrowers, and to continue developing presentations like you. So there's a link here that takes you to the survey, as well as a QR code in case you are tech savvy and you know how to use that. And then finally, I'm going to go ahead and give you some time for questions, but I also want to let you know, if you have a question and we're not able to address today, you can go to the student complaint and question portal to submit your own question. So I just want to make sure that we highlight that in case we're not able to get to somebody's questions today. So thank you so much for allowing me to present. And I will give you now a little bit of time to ask some questions.
Beautiful. So first of all, excellent job. I don't even know how you covered all that data in such a short amount of time, but we do have several questions. And so I'm just going to go through them briefly in the order they came in the chat. And then we have some that came in through the registration. So answer them as quickly or as easily as possible. So the first question is, what if I didn't borrow the loans in Washington State, but went to school in a different state? That's still, if it's federal, it's covered. Is that right?
Correct. Yes. As long as it's a federal student loan, this everything that we talked about should still apply. So
Beautiful.
it doesn't matter which state.
Next question is, does the IDR consider costs for insurance or 401k Roth contributions?
No, it does
in
not.
the calculation? Okay, great. Next question is, does the IDR adjustment also halt interest accruement?
No.
Or is that only on save?
No, the IDR account adjustment does not have anything to do with interest accrual. And the only plan that is currently available that it's not that this is the thing that gets complicated to people. It's not that your interest doesn't accumulate. It does accumulate every month, right? But when you make your payment, let's say, for example, your interest accumulated in the month was $50 and your payment is $30, right? Your payment technically doesn't cover the entire interest. So there's still going to be like that $20 that hangs there. That's what actually gets basically taken away if you're on the safe plan. It's not that the interest doesn't accrue. The interest accrues. It's just that if what you pay every month doesn't cover it, then whatever that balance is, that gets wiped out.
Got it. Okay, great. Here's the next question. If you need to defer due to unemployment, does that put you at a disadvantage somehow?
If you're hoping to eventually get forgiveness, whether that is because of public service loan forgiveness or income-driven repayment, that deferment may not count towards forgiveness. So if you're able to sign up for income-driven repayment, and by the way, you can use your current income right now as an unemployed person, right? You don't have to use last year's income. It's whatever your income is right now is what would get used on the calculation. So I would recommend, if you can at all costs avoid that deferment and sign up for an income-driven repayment plan, that's a better option because you're going to be working towards forgiveness.
Beautiful. All right, next question. So if I started this process last year because of the pause, can I activate it again?
So I guess I would need a little bit more information. You might be a good person to actually use our complaint portal, because I don't know what you mean by process, right? Like, do you mean that you signed up for income-driven repayment and maybe you didn't go through the entire process, right? So I need to get a little bit more information about your specific situation to be able to answer. So if we can't get to you today, please use the complaint portal to get to us. So
wonderful.
That's my answer.
Wonderful. I'm just going to keep moving through those, and then there'll be a time for additional questions. One question came through is, can borrowers on the SAVE plan qualify for the PLSF?
PSLF, yes. As long as,
yeah, sorry.
Yes. As long as you're employed in a qualifying public employer, yes, you can be on SAVE and be making those qualifying payments for that type of forgiveness.
Lovely. And just to note, there are a lot of appreciations in the chat for your presentation. So I just want to make sure we said that.
Okay, great.
Here's another question from the registration. Does this loan forgiveness work for medical student or medical school loans?
It can, right? So it doesn't really matter what you went to school for, right? So you could potentially get income-driven repayment forgiveness for medical student loans. Which, by the way, I know that sounds crazy, but I have helped people that have been in repayment for a long time because of their student loans for medical school. So yes, it's totally possible.
Perfect. Here's another question. If I'm an entrepreneur with little or no income through my business, but I work an additional outside job, can I qualify for the zero monthly payment or forgiveness?
So whenever we're looking at any IDR, right, in calculation of monthly payments, it's going to take into account your household income. So it will include any income that you might have from any job, right? So whether or not you could qualify for a zero monthly payment depends on how much you're earning through that other job.
Awesome. Okay. Next question. I would like to know if I'm already eligible for forgiveness, as I have worked in state government for over 20 years. I have not been in an income-driven repayment plan, but have worked in qualifying employment for 2 different states.
Okay, so it does sound like you may qualify for forgiveness, but we're not going to be able to cover all the steps for that today. So you're, again, one of those people that I would recommend going to our complaint portal and submitting a request for more one-on-one assistance, because it does sound like you might already be eligible for forgiveness, but it might take some steps to get there. So just reach out to us.
Great. And then there's another question was, like, are these terms really up to 25 years? That was all the question.
Yes, I know that sounds, it's really hard for people to like imagine 25 years into the future. But the thing is, I work with people every day that have been in repayment for that long. Like, I think a lot of people also don't think that they're going to be in repayment for that long, but life happens, and they end up being in repayment for that long. So I know that it can be hard to imagine being in repayment for your student loans for that long, but if somebody is low income and like they have been in low income for a really long time, at least these plans give an option to eventually get out of that debt, right? Which in the past they might not have been able to, because
Totally.
even though they might have been in repayment for 25 years. So
Totally. Comment, this was a wonderful presentation. Thank you, Jessica. Another one was, this was so valuable. Thank you for sharing this with us. The survey, okay, let's see. I signed up for forgiveness, but then the government shut it down. So any response to
that, right?
Yeah.
So the forgiveness that this person is talking about was what was called the one-time debt relief, right? So it was an opportunity that could forgive loans for people under specific income thresholds, from anywhere to $10,000 to $20,000 in student debt. That unfortunately got shut down by the Supreme Court, right? And
Right.
Unfortunately, there's nothing that we can do about that. That's kind of dead in the water right now. However, right, I would highly encourage you to, one, look at some of the options that we talked about today, and also keep an eye out, because the Biden administration has not given up on potentially giving broad forgiveness. It's just that they're currently working on trying to find an alternative for that. Of course, I always tell people, don't hold your breath. If you can start working towards other options right now, do so. But be on the lookout, because there might be some other type of broad forgiveness that is made available in the future. And I recommend, if you want to be in the know about this kind of stuff, to sign up to receive emails from us on our website.
Well, I'll tell you, so there's one more comment. This person graduated in 2004, and 25 years will be 2029. So it's heavy. It's heavy.
Mm-hmm. It definitely is, right? And I don't know if they have graduate loans or undergraduate loans. It's possible that you might already be closer than you may think, because it could be that it's in 20 years instead of 25. So yes, I know that it's a long time. It's a long time to be in repayment. And but at least, like I said, at least there is some light at the end of the tunnel for those folks that have to be in repayment for that long.
Absolutely. So we are at time, and I want to say, wow, humbly, thank you. Beautiful job. Just want to say this is very dense information. People were very patient. You were excellent. I actually really understood and listened to every detail. For those of you in the chat or here or watch this in the future, please take a picture of that QR code or go to the link that's in the chat so that you can give Jessica feedback, and then we can also get feedback on how we can do this kind of webinar in the future. I want to say thank you for all of the folks out there working with small business owners who can help them through the process. If folks did not get their question answered, go to their website, ask the question, just go in that, spend the time it takes, because really dealing with it now will be really helpful. And without further ado, I want to say thank you to everyone. Jessica, thank you for your presentation. Everyone have a great afternoon. We will talk with you soon.
Thank you, everybody.
Thank you.